All right. Good evening, everyone. Welcome to another Asset Management Monday. Hope everyone can hear me. I'm going to go with a yes. You can hear me. Can you hear me, Sean? Awesome. Great.
Yeah,
Welcome,
I
everyone,
can
to
hear you.
another Asset Management Monday. Happy Monday. Happy Indigenous Peoples Day, Columbus Day, etc. Where are you guys? I haven't seen you before, Lilia. Where are you guys all calling in from? It is officially sweater weather where I'm in. Speaking of weather, I've been under the weather, but Sean, you're in California, right?
I'm in Florida.
Oh, Lord have mercy. Okay,
No,
tell us
I'm
about that. Tell us about that. Where in Florida are you?
I'm here in Delray Beach, so we're not affected by
By either
the,
one?
the hurricane.
Oh my gosh, bless
We're
your
on
heart.
the East Coast. The hurricane was in the West Coast.
Interesting. So Florida is a whole country. You have East Coast, West Coast of Florida.
We
That's
have our own East Coast and West Coast.
interesting, interesting. Well, I'm glad you could, tune in. Welcome, welcome.
Thank you.
Thank you. Sean, are you in California?
no, I'm in Houston, Texas.
I knew it was somewhere warm. Um,
Mhm.
That's awesome. Well, welcome everyone. I'm not going to take too long. This is the Asset Management Zoom series of the Multifamily Freedom Chasers community. We run this every other Monday, and today we will be going over risk versus reward. Practical examples of how the capital stack placement shapes investor returns. And not yesterday, I apologize, last week, which was really 2 weeks ago, we went over briefly the capital stack and what that looks like. For those who may not be familiar with the MFC community, or people who are tuning in online or who are going to watch this after, the Multifamily Freedom Chasers is an online ecosystem that's geared to working professionals, showing them that financial freedom is possible through the acquisition of investing or apartment buildings. And that's kind of who we are. Every other Monday, we either have an asset management Zoom series or we have a celebrity guest come on in an activation Zoom. And then on alternating Wednesdays, we either review what the debt market is looking like or we go over broker calls / napkin underwriting. All right, this Zoom series is hosted by Bibi and myself. She runs Blue Ocean Equity, has been in real estate for well over a decade, is an asset manager an asset manager. She's actively and passively invested in different properties, as I am. She's down with you there in Texas, Sean, and I'm up in Massachusetts all by myself. I don't think I see any other New Englander um, on the call. Eric, are you from New England by any chance? Great, so I'm on my own. Fine, be that way.
Oh.
Hold on 1 second. Let me admit more people into the room. All right. We would love to hear from you. Here are here's our contact information. Hi, Trevor. It's been a minute. Nice to see you.
I keep missing your calls. I always want to come. Sorry. I
That's all
made it.
right. Thank you. Thank you for being here. Thank you, Dr. Holt, as well. You were one of the first to jump on. And so that's how you can reach out to us if you have any questions. We also have a WhatsApp community, and I will drop this link in the chat, or you can scan the QR code if you're not already a part of it. This is another avenue in which you can reach out and stay connected with the entire community as well as the leadership. All right. I will stop share. So I am the only one wearing a sweater on this call. This is just interesting. Okay. So, Bibi, did I spotlight the right to you?
Yeah, I have two on. So let me do the two, Blue Ocean and Bibi.
To spotlight both?
Yes. I make both co-host.
Hold on 1 second, I have to admit. This person. There we go. All right, I think we are all set now. Let me know on your end.
Connection lost.
What was that? I didn't do it?
No, not you.
Okay.
Okay, I think I'm having issues with my mouse. Okay.
Oh, no.
It's back again.
Okay,
Okay.
you good?
Yes, I'm good. So
Awesome.
hello everyone, good to have us again. And today we're going to just continue with what we did last week. Last week we spoke about capital stack and also I went on the surface level. So today is more of practical to let you know the implications of capital stack, how these things can directly affect your investors and can affect you as a GP if care is not taken. As much as possible, we are all looking for a way to make the deal work in the sense that we want to raise little and take more from the lender or from people. So that is the idea. But as you are doing that, you also need to be very careful that you balance off the entire thing so that you as the GP is satisfied, your LP investors are satisfied, the lenders are satisfied, the equity partners are also satisfied. So those are the things you want to achieve in the entire process. So there's going to be some form of imbalancing to do and all that. So today we're going to dive into more practical, please just, I don't know, my mouse is just, all of a sudden it's, my mouse, okay. Well, we're going to dive deep, we're going to dive into this now. Let me use my other system. So last week we discussed the difference in the capital stack in terms of can you see my screen?
Yep, we see it's not
Yes, okay.
presentation mode, but we see a table.
Okay, last week we discussed
Right now it's the SDA screen. Is that what you want to show us?
no.
Okay.
I don't know, I'm having some technical issues, but okay, so since I can't get across to my system, before I go into, I think I can share the SDA. But last week we talked about the capital stack in terms of the lender, which is the senior lender. And we also spoke about mezzanine, and we spoke about preferred equity partners, and we also spoke about the common equity. And what we discussed, this is just a summary of what we discussed last week. We discussed that the senior lender, which is the first lender, have the lowest risk because the collateral on it is the property. So for example, if you are foreclosed, the property, they take over the property from you. They just take that. Then for the mezzanine, they take ownership of the operations they put a lien on the management of the property. So that is how they are compensated. So the first person that gets paid is the senior lender. The second is the mezzanine if you took a second mortgage. So a mezzanine is in form of a second position mortgage that bridges the gap between the main loan and the equity. So for example, if you're doing an assumable loan, and the assumable loan is about 50% LTV. When I mean 50% LTV, I mean that it's 50% of the purchase amount. So assuming your purchase amount is 16 million. So 50% of that is what your assumable loan is. And that means you have to raise another 50% of the 16 million. In order to breach that 50% of the 60 million, which is about 8 million, you can decide to arrange your capital stack by getting a second position mortgage. So getting a second position loan is the second stage you can go. Let's say, for example, the second position gives you 1.6 million and you still have to raise another 3.4. You can still go ahead and say, okay, I need pref. Maybe I'll take a 10% pref. You can get a pref equity partner to give you 10%, or you get your common equity. Common equity is your LP partners. You can also get them to raise that money for you and all that. So all these things I just mentioned have implications. And I'm going to show you now through the underwriting. I'm going to use a deal as a case study. I just wish my system can come on. Please just give me a few minutes. Let me see if I can make it work.
Sean, I'm gonna pick on you. During this intermission, you have to give us some jokes or something to fill the time. Just kidding.
I was gonna say, like, I don't know what kind of jokes I should tell.
You can start with dad jokes.
And I was going to tell Bibi to get Apple. Stop relying on Windows.
I know. I know. Shout out to all the Android lovers, calculator users.
Bibi, just get Apple.
I'm using Apple, and that's why it's messing me up.
Ah, no.
It's Apple I'm using for crying out loud, so that is why I'm having issues. I normally like my PC.
Oh, I think that's what the problem is. She doesn't know how to use the Apple, so she's blaming it on the Apple.
I know how to use Apple for the Zoom calls, but not to share and all that. Yeah, so let me see. I think I can. Okay, good. So let me use my other system. Okay, so in the case study here, I have a deal that is 16 million. The purchase price is 16 million. And I need to give the scenarios. I wish this, okay, I think this thing is working.
So we see the SDA, but we can also see part of your PowerPoint.
There's a PowerPoint I want to share because I want to show you guys the, okay. Full screen. Okay, good. So these are the scenarios I have on this. So in this scenario, it's not big, right?
Well, it's a split screen. So it's
Okay.
half PowerPoint, half SDA. Is
Yeah,
that
I'm going to take it off. The first scenario here is a sample of what an LTV of a 70% will look like. And if you have to raise 30% of this. So what I'm trying to say here is that the deal is 16 million. I want to, the lender is going to give me 70%. That means I have to raise 30% maybe for my LP partners and maybe for my GP partners. We all have to come up with 30%, which is the common equity. What would be the implication of that? So if I would like to show you that in just a second. I am not liking today's presentation. How do I stop the split screen?
So you still have the capital stack screen split with the SDA.
So are you able to share, instead of sharing the documents, share the entire screen?
Screen, yeah.
That's what I want to do, but I'm not
Oh, okay.
finding that. Okay. This is super annoying. Okay.
Before you share your screen, why don't you minimize one? So stop sharing, take one down, and then just full-blown show us one or the other.
Unless she wants to go, in and out of both.
She might.
I don't know. I need to exit this other one. I cannot just, let me just close this. Sorry, guys, this is.
All right, now you have the SDA. Okay.
Okay. So let me maximize it. So can you guys see my screen now?
Yes.
Okay, so I have a deal that is 70% LTV and I'm raising 2%. So if that is the case, if you're familiar with Michael Blank's SDA, this is the implication of this. The lender is giving me 11.2 million, which is a 70% LTV. And if the lender is giving me that, that means myself and my LP team, we are going to raise about $6.8 million. In doing that, this is the implication of what this deal will look like. The IRR on this deal will be 15.26%, and the average cash on cash will be 6.68%. This is because the leverage here is at 70%, and based on this deal, you're going to only get a 6.6% cash on cash. Let's do another scenario. Scenario 2. Let's say we have a lender giving us 70%, and we have a mezzanine of about 10%. That means we are raising 20% of it. The same deal, the same purchase, everything the same, but the only difference in this case is that I'm taking a mezzanine loan. What would that lead to? What kind of decision would that lead to? Before I go into that, I'm going to give you the implication of this, what the returns will look like in terms of cash flow for you and your GPs. So in whatever you are doing, the most important thing is you are considering your investors first. So in this place, if you look at it, it means that if I take a 70% cash on cash, And
No.
if I take a 70% LTV, it means that the cash flow will be 70%. That means that if I have a GP split of 70-30, that means my LP members will have 417,000, and we, the GPs, we have 179,000. Please do not forget this thing. Just look at it, because we're going to run 4 different scenarios, and you're going to see the difference of arranging your capital stack. Going by this, some of you will say this is a bad deal because the average cash on cash is 6%. And some people, I've seen some investors that if the average cash on cash is not, let's say 8% or 7.5, they will not do the deal. But because of capital stack, you can actually make your deal profitable. But at the same time, you want to be sure that you are not over leveraged. That's the most important thing. So if we do a second scenario, let's say we have, like I said, a 70% loan from our senior lender, and we have a 1.6 million as mezzanine, which is a second position mortgage. And this, like I told it in the last week, I said the mezzanine's interest rate is typically higher than the first mortgage because of the risk. They have slightly higher risk than the senior loan, so they tend to increase their interest rate. So as the scale or as the stack is going up, the interest rate goes up with it. So that's the interest rate increases as the capital stack increases. So for this one, I am assuming I have about 7.5% that they're giving it to me for 7.5% interest rate, and at an IO of 12 months. That means in 12 months, I will not pay the principal. I will only pay the capital and all that. So this will be the difference from the other one. This one, I have a mezzanine. The other one, I do not have a mezzanine. So if I take you back to where the returns is, you find out that my average cash on this one is about 6.94%, slightly higher than the previous one. The previous one was 15.21. So it's about 1 point something percent in terms of internal rate of returns higher than the other one. Sorry, it's about 2 point something percent higher than the previous one that does not have a mezzanine. So this one has 17.62% as a because I'm using mezzanine. That means the internal rate of return has gone up. And if you look at it, my multiple, the other one, I didn't talk about that. The multiples on that one was 1.90%, but this one is about 2.09%. So in a case like this, you have to look at exactly what your investors want. So let's go to what is the implication for you as a GP member. So you as a GP member, it's not still bad. You're still getting good cash flow. Your LPs are still getting good cash flow. You're not over leveraged. Everything is fine. It's just that you need to be sure that your investors are okay with you giving them a 6.94% cash on cash. We have some investors that are particular about cash flow than appreciation. So if you have those kind of investors that want to see 8%, 10% cash on cash, this might not be a good strategy for you. But if you have an investor that likes both appreciation and cash on cash, they do not mind if it's slightly at below 7%, you can do your capital stack in this form. So this is the second scenario. So I'm going to show you a third scenario on the same deal. What will be the implication of that? So on a third scenario, I still have my 70% LTV, which is 11.2 million. I have a mezzanine of, that is a second position mortgage of 1.6 million at 7.5% interest rate. In this case, let's say I decided that I'm going to give my LPs, I want to give my LPs 7% preferred returns. So when you hear those preferred returns, the idea of it is that you are putting them as priority. That is, after you've paid your lender, that is the first position, the second position, the next priority would be anybody that has pref returns. So if you're telling your limited partners that I want to give you pref returns, that means after I've paid off my lenders, my first two lenders, you are the next on the capital stack that I should pay. But if you did not tell your investors that you're giving them pref, it means that if you have a deal and you did not make profit on that deal, and that deal is supposed to just be maybe 7% cash on cash, and for some reasons you didn't make money, it means that you didn't make money. So you can as well report to your investors that I didn't make money, so it's zero. There was no profit, so it's zero. But preferred returns is even if you didn't make money in year one, you can defer it to year two. That is the waterfall. That means if I don't give it to you in year one, I can move it to year two. If I don't get it in year two, I can move it to year three. And if at all I do not get it throughout the whole period, I can give it to you at the exit. That means when I'm selling or refinancing, that is after I've paid off the lenders, you'll be the next priority before we start doing the 70-30 GP split. So that is for that. So let me go back to the third scenario. So this third scenario, we have the 70% LTV, we have the mezzanine, and we promised our investor a 7% preferred returns. So let's see what would be the implication of that. You can see the dynamics have changed significantly. It means that now they're going to get an IRR that is way above the other two scenarios, and their cash on cash here is also going to be way above. So the same deal, the same purchase amount, but the way the capital stack was structured has given me a different returns for my investors. So that means when you have a deal, you really need to figure out the best route that can make the deal work for you and for your investors before you say the deal is not good and all that. So from a deal that was 6.5 average cash on cash has now become 9.04 average cash on cash. And the IRR has also improved. It's about 19.50%. And my multiple on this one is about 2.19x. What does that mean? That means that I'm going to get double plus, more than double the amount I invested. So if your investor, anybody that invested 50,000 is going to get more than double that amount. So it's going to get 100 and something thousand returns after the entire 5 years and all that. So, but let us see why you should be careful about doing it. It looks very attractive, right? The cash on cash is good and everything. Let's see the implication to you as a GP member. What would that look like? And how would that affect you? So this is the implication of it. It means that you are making money on this deal. You made a total cash flow of about 529,190. That is, after you've paid your lenders, you've paid everybody, you made this profit. But because you promised your investors, your limited partners, preferred returns, they come next before your GP split. So you are going to give them 70% of this. I mean, you're going to give them 7% of this. 7% of what they raised. So for example, if your GP members raised 3 million, let's say, I say your GP, your LP, your limited partners, your common equities money was 3 million. So you're going to give them in year one, 7%, because that's what you promised them, 7% of what was raised. So if you collected 50,000 from an investor, 50,000 will have the investor will have 7% in year one and have 7% in year two, year three, year four until the end. That is how you're going to pay that investor. The downside of this is that, for example, doing this exercise and something happened to this deal and the tax was increased. Let's say my tax became, let me go back to the scenario tab so that I show you the implication of that. So let's say, for example, my tax was 400,000. My tax increased to 400,000. This would be the implication of that. So initially I made a profit of 500 and something thousand. right now, my profits are significantly reduced to 399. You should also remember that there are some expenses that you don't have control over. Yes, you've projected for them and all that. Like what is happening in Florida. Many people that have multifamily there would have projected insurance to be this, but I foresee that in the next 12 months, insurance will double again, which it has happened before, and now it's going to go even higher. And because there's no competition, many insurance companies will leave. So if that happens, that means insurance costs will go high. So for someone that has said, my insurance cost is going to be 200, and come year 2, it becomes 350. It means that your cash flow has been affected. And what is the implication of that? It means that, look, if you look at this box, I want you to concentrate on this. My cash flow has reduced because my insurance went up by a significant amount. So based on that, I do not have cash flow to give to my GPs, and I do not have cash flow for my LPs. The only money I have is the preferred equity. So sometimes you hear when people say, do not do preferred equity because it's risky for you as a GP. This is one of the reasons why they tell you to avoid structuring your deal to have preferred equity. So for me, I've looked for better ways in managing preferred equity. Yes, we want to make our deals good for our investors. At the same time, we also are in this not as a non-profit. We're also in this business to make money as GP members. So you're putting your investors first, and at the same time, you're also trying to make it good for you. So what I do with my team is I always encourage them to invest their money. When they're investing their money, they're investing it as a limited partner. So whatever advantage the limited partner has, they're going to have it. So for example, if that year the insurance went up, we're not able to make our insurance, our insurance doubled, our cash flow reduced. Based on that, we don't have any cash flow. Because we as GP also invested as an LP, we might not feel the brunt of it, because we'll also take part in this 346,000 cash flow, preferred equity, preferred returns. We'll be part of it because we also invested as an LP. So this is unique to us, to me. This is how I've decided to navigate or mitigate the risk of that. But if you are different and you see that this is not the way you want to go, you might try to avoid using pref, although it makes the deal more attractive. If you're an LP partner, it's very attractive for you, but as a GP partner, you might end up not making money throughout the entire 5 years. So if you look at this deal, because of one mistake, because of one single expenses went up, my entire cash flow has gone. So capital stack is very important that you look at it and don't just be distracted because the numbers look good. You also need to look at other factors and be sure that this is good for you. So I'm going to show you a thought scenario. In this thought scenario, I have the senior lender, I have the mezzanine, and I have the preferred equity partners, and I also have the common partners. So the preferred equity partners are third party, maybe private lenders. I called them in, maybe I was not able to raise the entire money. I decided to reach out to the preferred equity partners to give me more money. This is how that will look like. So I'm going to give you another different scenario. So I'm going to stop sharing this, and this is going to be the fourth scenario. So on this fourth scenario, it's a little different because in this capital stack, I have I have 2 lenders and 2 equity partners. The first lender is maybe an agency bank or a bank. That's the 11.2 million. The second one is maybe a small bank or a private lender giving me a mezzanine, or even the main, the senior lender giving me a mezzanine, because the senior lender can decide to give you a mezzanine loan as well, a supplemental loan added to your senior loan. So for the purpose of this, I'm going to assume that the first lender is giving me the mezzanine, the supplemental loan, and they're giving it to me at 7%. So looking at that, based on this, that means my raise is going to be somewhere around 4.9 million. Let's say I've looked up and I've looked down, I still cannot raise 4.9 million. Sorry. So let me rephrase. So in this scenario is slightly different from the other one. In this one, I have an assumable loan. I also have a supplemental loan. So the assumable loan on this is 9.5 million. And I have a supplemental of 1.6. And the total of it is going to give me about almost 70% LTV, which is about 11.2 million. So the blended rate of both, let's say, is about 4.9%. So in this box, you are saying, like I said, this fourth scenario is slightly different. And the reason why it's different is because this underwriting, this SDA does not give us the opportunity to model 4 different kinds of capital stack. So we did some little alterations on it for us to be able to achieve that. So this is quite different from the other 3 I shared with you. So in this case, I have the first position and the second position all in one place as blended with the interest rate of 4.9, both of them at a blended interest. When I mean blended, it means that the average of both is going to give me the interest rate. So the average of 2 of them is about 4.90. There's a formula for that, but I'm not going to go through all that. So it's not the typical average, it's a different formula to get the blended rate of the interest rate if you are trying to do a senior mortgage and a secondary mortgage. So for the purpose of this webinar, I'm going to just tell you that both of them, we are going to assume that the senior and the supplemental are all in this bucket, 11.2 million. And the blended interest rate is 4.9 million. So based on that, that means my raise is still going to be about 6.9 million. But in this case, that means my raise is going to, my raise is still relatively high. It's about 6.8 million, but I'm like, 6.8 million is too much for me to raise. I need to get a partner, a private equity partner that can help me out. So I can decide to reach out to a private equity or a family office people to cut me some check. And they said, okay, I'm going to give you 2 million. So if they give me 2 million, they've given me 2 million, sorry. So let's assume they give me 2 million, right? And they're saying that the interest rate of this is going to be about 14%, because like I told you, as you move higher in the pyramid of a capital stack, the interest rate goes up. So preferred equity partners are between 14 to 18%, depending on the people you are meeting. So for the purpose of this, I'm going to assume a 14%. So after meeting my preferred equity partners, they said, this deal is 14%, but we can arrange it in 2 ways for you. You pay us half of it on a monthly basis, and the other half of it as pref returns. That is, you can defer it and be giving it to us every year. If that is the arrangement I have with them, so if the total is 14%, that means half of it will be 7%. That means they want me to pay them 7% on a monthly basis, and the other 70% of 2 million, defer it, we're paying it to them once a year. So this has changed the dynamics of the entire capital stock. So if this is the case, that means I'm going to be giving them 7%. I'm going to be giving my lender, the senior lender, some percentage. I'm going to be giving them for the mezzanine some percentage. I'm also going to be giving the preferred equity partner 7% monthly. So my monthly payment is going to come in 3 tranches. I'm going to pay 3 different people. Then for my pref, I'm going to pay 2 different people. And who are the 2 different people? This same preferred lender. The other 7% of his 14%, I'm going to pay him. And remember, I promised my LP members 7%. So that means I have 2 preferred returns to give to both the preferred lender and to my LP lender. Imagine what that will do to you as a GP. That means it's going to be zero cash flow. That means you are making money for other people to enjoy. Although the deal is going to look very, very good. It's going to look more attractive to your investors. But for you as a GP member, it's going to be terrible. And maybe, and also to your LP members, it's going to be terrible because you remember you have the preferred lender to also fulfill an obligation to, and they are also priority as well as your LP. They are also priority. So that might be a challenge. So let's see the implication of this. There's a caveat on this. We've tampered with this underwriting to help it function to what I'm saying. So this is not your typical SDA. So some things have been done for us to see the implication of what that will look like. So if I go to the returns tab for this, you look at it here, you see the deal looks very attractive. I'm having an average cash on cash of 7.81%. The multiple is about 2.15%. My IRR is 18.56%. If you look at this, you say this is a fantastic deal. I'm happy, everybody is happy, but guess what? Let me show you something. When you go to the P&L slot of it, this is where you know that this is really bad for even your limited partners. In this scenario, my cash flow here is about 345. So after I did everything I did, I only made a profit in year 1 for 345,000. And I owe a preferred equity partner 7% of that. And I still owe my LP partner another 7% of that. And if I do that, that means I'm going to have a deficit of 49,723 in year 1. It means that I'm at a negative. That means there is no GP split. I'm not going to get peanuts, and my LPs will not get anything. And even my LPs will not get their complete preferred returns. The only person that is going to go home smiling is the senior lender, the mezzanine lender, and the preferred equity lender. Those 3 are going to go home with complete money. But my LP's pref will not be complete. I'll have to defer it to the next year. And me and the GP, nothing. And as well as the LP, no cash flow. They will not have a single dime. The same thing in year 2. Year 2, I made a little more profit. I made about 446,000. And in that 446,000, I paid part of it to my LP, to my preferred lender. And I also paid majority of it, including the one I was owing my LP for last year. I paid them, but I still had an outstanding amount of this. But if you look at my GP, nothing. I have nothing. And this thing continues to the 3rd year. In my 3rd year, I was able to make a little cash flow. In my 4th year, a little cash flow. And on and on and on and on. So if you as a GP are not patient, you might be pushed to sell the deal because there's nothing motivating you to do it. It feels like you are working for people to enjoy. So this is why you see that some deals are not mature and you see some some sponsors selling or deciding to exit or refinancing when the property has not even achieved the value. The average time for your property to reach that peak is typically between 3 to 5 years. So because of this, some LP members, some sponsors, GPs might be frustrated and say, we can't wait for 5 years. This is not good for us. I'm not getting anything. I'm working hard and there's nothing. I have to sell. So you don't want to find yourself in that shoe. But if you're looking at it from the bigger picture, you will see that the returns are good, but is it good for you as a sponsor? Is it good for your limited partners? Because remember, you promised them cash flow, and you also, not that you promised, there's really no promise, there's risk. You told them that there's going to be some form of cash flow, and you told them they're going to also have preferred equity. So, but because of the way you've arranged your capital stack, this has affected your investors' returns. And all that. So in other words, the idea of capital stack is for you to, let me stop sharing my. So in other words, the idea of a capital stack is for you to properly arrange your deal in such a way that it will be beneficial to you and also to your investors. That is the paramount idea. When you are looking at the surface level of the returns, you also want to check what the cash flow implication is going to look like for your investors, and what is it going to look like for you as a GP member. Remember, we are all in this to make money, including your LP and including you. So if you understand capital stack, you'll be able to know how you can arrange it that you will not be over leveraged, one. Because if you look at the last scenario I showed you, the raise was extremely low. The raise for the common equity was about 400 and something thousand. That means you took a lot of leverage from lenders and equity partners, and you raised peanuts. And the consequences of it is that your deal will not be profitable for you, but for them, it will be profitable. So that's the summary of what I have to say today. So capital stack is very, very important. And when you as an LP, when you see a deal, you need to really, really scrutinize it to know how they have stacked their, how the capital stack is arranged and how it's going to affect you in terms of returns. So I don't know if anybody has any question. That is, sorry, I was not able to function as I should have, but at least we're able to see the underwriting for you to know the implication of each of them, the different scenarios that we shared.
Thank you so much, Bibi, for that excellent presentation. It's not a question, I just wanted to add another thing that I've seen happen when you approach the equity people. Sometimes they also ask for a certain percentage of their interest upfront, like before they even disburse the money to you, they want you to pay some amount. So by the time you add that, and then you add, whether they're splitting it into yearly interest or dividing it into paying some interest, over the years and then taking the rest over the next couple of years. Whichever way you slice it, preferred equity is only going to hurt the GPs. And it makes the deal look very, very good, excellent. And the team might feel like it's really good for them because they don't need to raise that much money. But on the long run, it's not a very good way to structure a deal. I think, we should all strive to be very, very good and excellent capital raisers and be able to raise, the capital for the deal rather than leaning on all this extraneous.
Sorry, I would like to comment on this. Please, I hope you guys understood what I said. I did not say preferred equity is bad. It's not bad. It just depends on the deal. So any deal you have, you just have to check it out to see the implication of what preferred equity will do. Some deals preferred equity works perfectly. It's beneficial to you as an LP, as a GP, and all that. It just depends on the deal. Like I always mention, no single deal is the same. Every deal is different. So preferred equity is not a no-no. I've tried to use it. It depends. If it works, it works. If it doesn't work, it doesn't work. So like I said, you need to look at the entire picture to see what the implication will look like in terms of cash flow, what the implication will look like in terms of appreciation. Because when I mean appreciation, remember when you are exiting, you're going to pay those people off. You're going to pay them that chunk of money that they gave you. You're also going to pay your senior lenders. You're going to pay everybody you're owing. What will now remain as profit after you sold the property? So that's why I said, look at the bigger picture. What is the returns going to look like in terms of cash flow, in terms of appreciation, in every factors? If everything pounds out well, be my guest, use it. But if it does not, maybe you look at it, it's going to affect you, your cash flow in the long and short run, you might need to avoid it. So it's not cast on stone that is all bad. It can be bad, and it can also be very positive for your deal.
So essentially, as a asset manager, before you take on that role, early on in the, like right at the beginning, what you're encouraging people to do is to ask the sponsor, or whoever structured the deal together, to stress test the capital stack and see where a breaking point is. In order for you to make your decision, some people may be fine with no cash flow for 2 years, but at least if that's the case, you need to know what you're about to step into. So I think she's trying to point out the different aspects that we're supposed to look at. Don't just zoom in and focus on, oh, what's the cash on cash? What's the IRR? Also look at different components of what the capital stack implications might be to you as a GP, because that could determine your motivation. It shouldn't be the only deciding factor, but it could be. I think that is a takeaway. No, great. Thank you, Bibi, and thank you, Dr. Holt, for those comments. Who has a question based on what you've heard, or a comment, or something you would like her to clarify, etc.? And I did drop the WhatsApp link in the chat. I remember this week to do to do that. But who has a comment? Or let me rephrase. How many of us, when we've looked at deals, if you looked at getting on a deal, if you've been offered to come on a deal, how many of you have actually zoomed in or looked at that portion that, regardless of whether it's the SD or whatever analyzer is being used, how many of us have looked in that direction or thought about these things futuristically? Or were we just so excited to get on a deal and we said yes to anything?
I was guilty as charged before now. I don't know. I was a surface level, 7%. Oh my God, beautiful deal. 18% IRR, beautiful deal. I never used to zoom in when I started and all that. So yeah.
But so if you were an LP though, Bibi, would you say, like a savvy LP, would you say, hey, Mr. Sponsor, I'd like to see your underwriting. And if you see the 000 for the first 3 years, you're going to go, the GPs aren't going to be motivated. I'm not going to go into this deal. As an LP, I'm asking now as an LP.
Depending, like you said, because I'm savvy, because I also invest as an LP, because of the level I am and the experience I have, I go that step. But this is not unique to many LP partners. They don't just know, not because they don't care, they don't know that they could do that and all that. But for me, because I've done that before and I've seen pushbacks. Some say no, check the pitch deck and all that. So yeah, but for me as a GP, if an LP comes and says they want it, I'd rather like to jump on a call than sending it over to you, because every underwriting, the assumptions there, and you need to understand what those assumptions are. If not, you run into a different conclusion and all that. So that would be my answer.
Marvelous. Alrighty. Questions before we wrap up? We have a minute or two before the hour.
So when a person is considering investing, do you require anything from the person before you send out information?
Can you the question? I didn't hear that.
So let me try and re-ask that. So Alicia,
Alicia.
Alicia, thank you. Are you asking from the perspective of an LP. She said if somebody's considering investing, so when you say investing, are you investing as a general partner? Are you investing as a limit? Are you asking on behalf of a
A
limited partner?
limited partner.
Mhm.
If
Okay.
a limited partner is considering investing, do you collect any information from them before sending out? Anything or what exactly is the process?
Oh, it depends on the sponsor group, but typically you have to collect some form of information because one, you also want to screen them to be sure that they fit what you're looking for. You want to ask questions like, are they accredited or non-accredited? That will make you understand if they are non-accredited, the probability that they don't really, this is their first investment is very high. So that is one. The ones that are accredited, you might tend to treat them differently because they are savvy. Some of them, not all. Some of them are savvy and you should be ready. They'll be asking you some hard questions and all that. So it's important that you gather information to know who exactly you're dealing with.
Does that help?
Yes, that helps.
Yeah, awesome. Yeah, some form of relationship at the very minimum should be established, a series of conversations to try and establish who the potential investor is. I probably would not send them what Bibi just went over on your first call. Probably not. But yeah. Any other questions before we wrap up for today? Questions on the capital stack going once.
Well, I do have a question. So,
Oh, awesome.
okay, so do you actively look for investments on a daily, weekly, monthly basis? And and also, where do the properties come from? Are you working with wholesalers? Are you working with brokers? Do you have a team helping to find these properties?
Okay, so that is a very broad question. So it depends. It's not one size fits all category. You can get deals from your team. Depending on how your team is structured, you can be the one on the team getting it. So it's a very broad question. It just depends on what you're looking for and what your strength is and all that. So I will not be able to give you a one size fits all kind of answer for this. But the bottom line to your question is know exactly what you want, know your strength, because if you know your strength, that will determine if you're the one that will be looking for the deal. And if it's not you, you don't have that ability, then maybe a team member can help you with that. Then you can fit in your strength to the deal. Maybe your strength is capital raising and all that, and all that. Then for you getting deals, like what if you said relationship from brokers and multifamily, getting deals as multifamily is different from getting deals as single family. So if you are hunting for deals as a single family, you might go through what do you call them?
She said wholesalers.
Wholesalers, but
Yeah.
for multifamily, we have very few wholesalers. They are very few. They are not as pronounced as the single family one. They exist, they are. They do. They're even on some WhatsApp group I am on, but the best bet is creating relationship with brokers. And the way brokers are, they are not agents. So there's a difference between a broker on a multifamily and a broker on a single family. A broker on a single family is more like an agent that can represent you and maybe the buyer or you, then the buyer will have one. But for a multifamily, the broker is just the middleman. He's brokering the deal between both of you. It's neither for you now, neither for the seller. But because he wants to sell, he's going to like sort to a large extent favor the seller. But really, the job is a broker. It's supposed to be for both of you and all that. So depending on what you're doing, single family different, multifamily different strategy.
Alicia, I don't know if it helps, but on our YouTube channel, you can arrange the videos by playlist, and you may be able to find some of these fundamental, foundational type answers to these topics and areas. I don't know if that helps. So you can also post it in the WhatsApp group. But I want to say that I think over the past year, these questions have been either covered through here or we've talked about capital raising, we've talked about team structure, and then some of the other programming that has been done on the MFC community. Awesome. Well, I'm going to close it out. If there's no other question, I want to thank you guys for joining us on Monday, Indigenous People Day, Sweater Weather Day for me. Thank you guys for coming. If any question comes to mind, please drop it either in our Facebook group or in our WhatsApp group. Thank you for coming from Florida, Texas, California, East Coast, West Coast, everywhere you guys tuned in from. Have a good night, guys.
Thanks, guys.
Thank you.
Thank you.
Thank you.
Yeah, thank you. Have a good night.
Thank
Appreciate it.
you.
It was amazing.